Hey, good morning, options traders, and welcome back, everyone. Well, how much is that option? The one you just bought, that call or that put? Well, if you ask most traders, they're going to say, well, that's an easy answer. It's the total price that I just paid. Well, that might be true, and it might not be true. And that's why I want to revisit this topic that I've talked about in different forms many times in the past, but I just want to repackage it in a different format because I still hear a lot of traders getting this question wrong. And if you don't understand how much you're paying for the option, for the right to walk away, you are always going to struggle with option strategies. So how much is that option? Well, to see why it can be so confusing, recall that the option's price, the option's total price, is called the premium, and that's borrowed from the world of insurance. But traders often believe that this premium is the amount that they pay for the option. And you have to realize that while that's the total cost of the option's price has two components to it. There's an intrinsic value and an extrinsic value. And the intrinsic value is nothing but cash. It really has nothing to do with the deal other than to make the deal fair. But it definitely doesn't have anything to do with the option. Why? The option is the right to walk away. That's the value of it. And that's found in the extrinsic value. So just remember that if somebody says, what did you pay for the option? You really should be thinking, what did I pay for the right to walk away from the deal? That is the option. So for instance, let's say that the stock is trading for $100 and we see the $95 call trading for $6. So again, no, this $6 total price here is not the price of the option. I mean, yeah, technically somebody might say it's the premium, it's the option's price, but that's going to confuse you when it comes to strategies. You need to realize that, yeah, that's the total price or the premium, but let's break it down. If we have the right to pay $95 with this call for stock that's currently worth $100, that's a $5 benefit. There's an immediate $5 of an advantage hiding in that package, and that's the intrinsic value. Why? I could buy this call, exercise it, and spend $95 for the stock, turn right around and sell the stock for $100, and there's the $5 cash. So nobody's going to sell you this option for less than $5. That's why I said it doesn't really count in what you're paying for the option. So we know it has to trade for at least 5, but it's trading for 6. It's this extra $1 here, the extrinsic value, that is what we're paying for the true option. That is the price that we're paying for the right to walk away. So yeah, notice that the intrinsic value plus the extrinsic does equal the option's total price. But that doesn't mean that you should think of that option's total price, the $6, as being the extrinsic value. The price that you're paying to walk away in this example is $1. So if you asked a professional trader, what did you pay for this option? They should tell you it was $1, not 6. What about for a put? Same idea, different direction. We still have the stock at 100. The 105 put is trading for 6. Well, if we exercise this put, we have the right to sell our shares for 105 for stock that's currently worth 100. I could go out and buy the stock for 100, buy this put, turn right around and exercise it, and put $5 in my pocket. It'd be easy money. And that's the intrinsic value. So yes, as before, nobody's going to sell you this put for less than 5. The $5 is just to make the deal fair. But we're not paying 5 for it, we're paying 6. So it's this extra dollar, this extrinsic value, that is the way that you should be thinking of what you're paying for the option, for the right to walk away. And just as with the calls, for the puts, the intrinsic plus the extrinsic will equal the option's total premium, but don't let that throw you. It's the extrinsic value that you really need to keep your eye on when you're talking about the option. So just remember that the cash is the intrinsic value, and that has nothing to do with the option. The cash or the intrinsic value is designed to, You could think of it as making change or a way to balance the contract. You can also think of it as a meltdown value that's sometimes used in the gold or the jewelry market. So for instance, let's say that gold is trading for $2,000 an ounce, and you walk into this jewelry store and you see this ring and it has a price tag of $2,100. Now it just so happens that this ring weighs exactly 1 ounce. So the question is, how much are you paying for the ring? Well, on one hand, it's a little bit of a trick question because you could say, well, it's $2,100. But what I'm trying to show is that $2,000 of that is just intrinsic value. Because even if you got this ring, found out you didn't like it, you could melt it down, have an ounce of gold, and sell it for $2,000 cash. See, it's cash that's just hiding in that deal. But you can't buy it for just $2,000. You'd have to buy it for $2,100. So it's this additional $100 that we might call the extrinsic value. That's really what you're paying for the jeweler to have put this into a form, what you might call the craftsmanship, but that's not really what you're paying for the ring. $2,000 of it is intrinsic value, and there's really an additional value of $100. And that's the way you need to learn to break option prices down between this cash and the extrinsic value in order to make the most use of your strategies. So to see how it works and to see why it can be so confusing, let's go over to the E-Trade platform and take a look at some Apple quotes. So up here you can see that Apple closed at 132.05, let's just call it 132, and I'm going to start with the June of 22 calls, right here, 524 days until expiration. So let's look at a very deep in the money call, let's say a $70 call, right down here. Now with the stock at 132, that seems like it would be a pretty good deal if we had the right to pay 70 for stock at 132. What's it going to cost us to buy this strike? Look over here. There's the mark, $64.25. And again, new traders will look and say, my gosh, that's an expensive option, $64.25. No, it's not. If you're asking for somebody to give you the right to pay 70 for stock worth 132, there's $62 of cash you've got to kick into that deal. And that's what this value is right here. That's the intrinsic value. But the option didn't just cost 62, it cost 64.25. So there's some extra money that we have to kick in, and that's the extrinsic value. And that's right here, $2.45. Why would we pay this extra value? Because we have the right to walk away. We're not required to ever exercise and pay the $70 strike. We can if we want, but it's not a requirement. So we get the right to sit back and wait to see how things unfold. And if this option goes up in smoke, we are really $2.45 worse off than the person who bought the stock. Now there's a few ways to show this, but here's an interesting look. We've got 524 days until expiration, and we would have to pay $64.25 for the total premium. What do you suppose the option that expires this Friday with 6 days to go would cost? And again, new traders will get tricked and they'll say, well, if this one costs $64.25, that's going to be really cheap with only 8 days to go. Well, let's take a look. Let's go find the $70 strike, and right there is 62. Almost the same price. Why? Because it's all cash. All of these options, pick any of these across the board, all of the $70 strikes are going to trade for about 62. Sure, there'll be some additional extrinsic value the further out you go, but it's not going to be a lot because we're so deep in the money. And then therefore this strike is behaving almost like shares of stock. So to see why that's happening, let's go back over to the presentation. So for the Apple $70 call, I'm just going to use round figures. Let's say that we bought the 70 call for $64.50. Now if we exercise this option and pay 70, 524 days later, how much have we paid in total? We've paid $134.50, and we would be long shares of stock. Well, what if we had purchased the shares of stock 524 days ago rather than buying this call, what would happen? Well, we'd be long stock at $132. Do you see how the option trader only paid an extra $250 by buying this $70 call? He did not pay $64.50 extra. That was just to make the deal fair because he was trying to have the right to pay $70 for stock that was worth $132. So this is really the essence of all option strategies. How much is the value to walk away and how much is cash? And so some strategies will make use of cash, but they all make use of the extrinsic values. And so this is why if you don't understand how to break these two components down and to understand what you paid for the option, you will be forever lost with option strategies. So how much did you pay for the option? You paid the extrinsic value, and that was for the right to walk away. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.